All right. I thought about it, and the fact that the rand is not 7 rand to the dollar is not that big of a deal. What Kganyago did on October 16, when he claimed that purchasing power parity measures imply that the rand should trade near 7 rand is interesting, mainly as a theoretical framing, not as a practical forecast. The PPP model, Big Mac indices, and other similar fair value metrics create numbers that look dramatic because they measure local prices against international averages without accounting for the very real risk premiums embedded in South Africa's economy. Investors and markets are not making big decisions based purely on how much a hamburger costs where here versus in New York. They price in governance risks, the potential for policy missteps, historical growth patterns, capital flight, national debt, and the credibility of institutions. When you bring all of that together, the theoretical 7 rand number becomes a conversation starter rather than an actionable target, at least for today. It tells us what a perfectly managed economy might look like under idealized conditions, while the current market trades around 17 to 18 rand because it's balancing opportunity against real measurable risks. If you try to force the currency toward that number without fixing those underlying factors, you risk destabilizing everything from prices for consumers to interest rates and inflation. And that is why we have to separate theory from market reality. The real question is not whether the rand can hit 7 rand tomorrow. It's about what changes would be required for the gap between that theoretical fair value and the market rate to narrow sustainably over time without undermining people's standards of living, their investment confidence, or economic stability. Thinking this through, the practical side is all about structural change and credibility. For the rand to move meaningfully toward that level, South Africa would need clear, consistent governance that the market trusts. So, with enforceable policy, visible anti corruption measures, transparent fiscal behavior, and reliable infrastructure that supports production and commerce, debt levels will need to decline. Growth rates would need to rise enough to absorb labor and increase productivity. And inflation would have to remain controlled. Foreign reserves help, but they alone are not sufficient enough. Capital markets and investors respond to the expectation that reforms will persist beyond election cycles or short-term political pressures. The statement about 7 rand also functions as a policy signal, a tool to spark conversations about reform rather than a command to the market. It pushes attention toward the levers that actually matter, like improving investor confidence, reducing regulatory risk, diversifying exports, stabilizing energy supply, and even restructuring certain industries to ensure domestic retention of wealth. Without these foundational improvements, the rand will continue to fluctuate with external factors like the US dollar strength, with commodity prices, with capital inflows and outflows, rather than moving toward a purely theoretical target. So, understanding this distinction is critical because it shifts the focus from chasing a headline number to implementing reforms that improve purchasing power, that strengthen the economy, and that create a trajectory that benefits South Africans over the next 5 to 10 years, all while keeping inflation and cost of living in check. So, when we look at why the rand has moved from levels around 7 rand to the dollar in the past to the current range of roughly 17 to 18 rand, we have to understand that it is a result of decades of structural challenges and policy failures rather than a sudden market accident. Exchange rates are never just numbers. They reflect a long history of economic performance, of investor confidence, and political stability. South Africa has struggled with slow growth for many years. And this is not about 1 or 2 bad quarters. It's, in fact, about an extended pattern where GDP growth has rarely kept pace with global averages or even domestic expectations. That slow growth reduces expected returns on investment, it limits capital inflows, and makes foreign investors demand higher yields to justify taking risks in the economy. Then there's the issue of state capture and corruption, which has repeatedly undermined trust in government institutions and in the rule of law. When investors see uncertainty about contracts, about regulatory consistency, or the protection of assets, they interpret it as higher risk, which puts downward pressure on the rand. At the same time, fiscal slippage, meaning that the government spends more than it reliably collects, combined with high debt burdens, creates a structural vulnerability. These factors all interact. So, slow growth reduces tax revenue, weak governance encourages capital flight, and uncertainty around policy makes markets price in the risk, which leads to a weaker currency. It's not just a theory, you can actually see it in real data. For instance, foreign reserves have fluctuated, but never fully offset the risk premium built into the market. And episodes like the FATF scrutiny or inconsistent industrial policy feed into the same cycle of uncertainty. The rand is reflecting what the market thinks South Africa is capable of sustaining given these decades long trends. And no single intervention can magically restore it back to 7 rand without addressing the underlying issues. Right? Thinking through what that actually means in practical terms, trying to push the rand back to 7 rand without addressing these root causes is unrealistic and would be very dangerous for the ordinary person. The value of the rand is not just a number on the screen. It actually affects prices for food, for fuel, imports, and debt service, which directly impacts households and businesses. If policymakers tried to artificially prop it up without correcting growth or governance or fiscal credibility, the risks would be inflation spikes, it would be interest rate shocks, or even capital flight as markets adjust to the artificial manipulation. Correcting the exchange rate sustainably means focusing on structural reforms such as reliable governance, credible fiscal policy, investment in energy, transport, and logistics infrastructure, and measures to restore confidence in public institutions. Investor confidence grows not because of announcements, but because they see consistent, enforceable policy. They see predictable regulation and an economy capable of expanding production and exports. Once these conditions are met, the market would naturally price the rand higher because the risk premium drops and capital can flow more freely. That's the path to a stronger, more stable currency, not simply demanding or targeting a number, but building the foundations that allow the number to adjust in line with the actual economic capacity and social welfare. Until those foundations are secure, the rand's position at 17 to 18 rand is a reflection of reality. And understanding this reality is essential for anyone trying to make sense of the currency, for anyone trying to plan their investments, or even assess policy. It shows that exchange rates are ultimately about trust, capability, and predictability. And South Africa's history has shaped the rand's journey in ways that require serious structural repair to reverse. So let's think through how the current level of the rand, trading at around 17 to 18 rand to the dollar, impacts ordinary South Africans. And it is important to see this in terms of cause and effect rather than just abstract numbers. A weaker currency naturally raises the cost of import goods because every rand buys less foreign currency. And that directly translates into higher prices for fuel, medicine, machinery, and electronics. These are not just commodities on a balance sheet, they are everyday essentials for households and inputs for businesses that rely on imports to operate. When prices rise faster than wages, real purchasing power declines, and even workers receiving nominal pay increases may feel poorer in practical terms. Inflation erodes the value of savings, especially for people with fixed incomes or limited access to financial instruments that hedge against currency depreciation. This effect compounds over time. On the other hand, certain sectors benefit from the weaker rand. Exporters can sell goods abroad for higher rand revenue. Tourism operators see more foreign visitors willing to pay local prices. And mining companies benefit when commodity prices are denominated in dollars. These gains, however, are unevenly distributed. The question for South Africans is whether the revenue boost from exports and tourism is translating into tangible improvements for ordinary people, whether through increased employment, whether it is through investment in domestic industries or social spending that protects living standards. Without such mechanisms, the weaker currency functions as a slow, invisible tax on the poor, quietly eroding quality of life while benefiting a smaller slice of the economy that has access to foreign markets or dollar linked revenues. Understanding this dynamic is essential for evaluating policy choices and personal financial planning. If we follow the thread further, the interplay between wages, prices, and the exchange rate becomes even clearer. When inflation rises due to import costs and wage growth fails to keep up the pace, inequality intensifies because the impact of higher prices is felt most acutely by those who spend a larger share of their income on essentials. Social transfers and government support can partially offset these effects, but only if they are timely, adequately funded, and structured to reach the people who are most vulnerable. Otherwise, households face a steady squeeze that lowers real consumption and reduces economic mobility. At the same time, if export revenue gains are reinvested strategically, they can generate new jobs, they can stimulate industrial growth, and they can build infrastructure that ultimately mitigates some of the negative effects of currency weakness. The challenge lies in ensuring that the benefits of a weaker rand are not concentrated in a few sectors or regions, but are spread in a way that supports broader economic resilience. In practice, this means linking export performance to domestic value chains, incentivizing local manufacturing, and channeling gains into social and capital projects that strengthen communities. A weaker currency is not inherently harmful, but without deliberate policy design and structural interventions, it amplifies existing vulnerabilities in wages, in cost of living, and wealth distribution. For South Africans trying to make sense of everyday budgets, to maybe plan for the future or assess government policy, the key is recognizing that the exchange rate is a multiplier of existing economic conditions rather than a magic lever that automatically benefits or punishes the population. The effects of 17 to 18 Rand on purchasing power, wages, and overall well being are a product of how the economy and policy respond, not just it's not just a random number on its own. Now, let's think about the Rand over the next 5 years in terms of systems and feedback loops rather than just a single number on a screen. If South Africa were to pursue a path towards 7 Rand to the dollar, it would require a set of coordinated, deep structural reforms that go far beyond short term fixes. Fiscal consolidation must be credible, meaning that government spending and debt must be managed in a way that signals long term stability. The energy sector has to deliver reliable supply because frequent blackouts not only disrupt everyday life, but also limit productivity and investment. Corruption must be meaningfully curtailed, with high profile wins that reinforce the rule of law. Otherwise, investor confidence remains weak. So, Madlanga Commission vibes. If these reforms are achieved, they can trigger a reinforcing cycle. Investors seeing stability and governance credibility are more likely to bring capital into the country. That increases foreign exchange inflows, which in turn strengthens the rand. A stronger currency lowers import costs, which reduces inflationary pressure, creating breathing room for domestic growth. The lower inflation environment makes wages more meaningful in real terms, and it allows businesses to plan investment without fearing sudden cost spikes. Over time, these interactions from a self reinforcing system with policy credibility, capital inflows, inflation, and growth support each other, gradually embedding a stronger currency without relying on artificial market interventions. The challenge is sustaining all elements simultaneously because failure at any link, whether it's in energy supply, corruption control, fiscal discipline, it can break the feedback loop and reverse the gains again. Now, consider an alternative path where the rand remains near 18 rand or fluctuates widely within that range for about 5 years. This scenario assumes that the continuation of current structural weaknesses, whether it's modest inconsistent growth, occasional positive shocks from commodity cycles, or reserve increases, but There is no sustained anti-corruption enforcement or major energy stabilization. Foreign capital flows respond to short-term incentives, leading to sporadic rand rallies, followed by sell-offs when risks resurface again. Inflation expectations become unstable because price increases from imports hit households unpredictably, while export revenue gains remain unevenly distributed. Businesses and investors face uncertainty, which discourages long term investment, meaning that economic growth remains weak and employment opportunities become limited. Even occasional inflows from higher commodity prices or reserve increases cannot compensate for the absence of coherent structural policy, and the system remains vulnerable to global shocks, such as maybe a stronger dollar or falling commodity prices or regional political instability. From a systems perspective, the key question is not simply whether the Rand can be forced towards 7 Rand, but what combination of sustained reforms, governance improvements, and economic behaviors are necessary to create durable positive feedback loops that make a stronger currency stable over time. Without these systemic reinforcements, interventions to push the Rand higher would likely be temporary and could impose higher costs on ordinary South Africans. So, in short, the 7 Rand path requires an ecosystem of trust, credibility, and growth, while the 18 Rand path reflects the consequences of an incomplete system where small gains appear intermittently but cannot be reliably sustained. Yeah. All right, let's walk through why South African banks ended up paying fines instead of being forced to correct past exchange rate manipulations, and why this is less about leniency and more about the mechanics of financial markets. When regulators uncover misconduct, the immediate tool available is to penalize the institutions involved, usually through fines, sanctions, and compliance requirements. These measures are tangible and enforceable, and they signal that certain behaviors are unacceptable. What they do not do, however, is allow the regulator to retroactively reset the Rand to some preferred level. Exchange rates are emergent phenomena. They result from billions of trades across the globe every single day, shaped by the interaction of supply and demand, capital inflows, interest rate differentials, and investor sentiment. Even if a bank pushed the Rand in one direction through improper trades, the actual market price at any given moment reflects the aggregate of all participants' actions. Attempting to forcibly move the currency after the fact is not just technically difficult, it would require massive interventions in the forex market, either through direct purchases and sale of foreign currency or through capital controls. Such interventions carry enormous political and economic risks and could destabilize trust in the financial system, so potentially harming the very households that the action aims to protect. The fines in this context are a compromise. They hold actors accountable, they create a deterrence, and they try to improve oversight without undermining the broader market structure that sets prices continuously. Now, if we think a little about the specifics of Rand manipulation, there are lessons in both the limits of enforcement and the vulnerabilities of the system. Between 2010 and 2015, investigations indicated that some banks may have coordinated trades to influence the Rand, affecting importers, exporters, and investors who rely on fair pricing, while households and businesses experience indirect losses through unfavorable exchange rates. Those losses were diffuse, making restitution complex and nearly impossible to implement retroactively. Regulators, in this sense, can penalize behavior, but they cannot rewrite history or redistribute what was lost in the market shaped by many actors over time. The structural problem here is understanding that currency markets are complex adaptive systems. Individual manipulations can influence short-term movements, but they cannot permanently fix or reset market values. Enforcing corrective flows would require the state to assume enormous control, a step that carries its own risk of undermining confidence in the Rand. So, while the fines may feel insufficient to ordinary citizens who saw prices rise or purchasing power erode, they reflect a practical boundary. Regulators can constrain behavior, they can tighten oversight and signal accountability, but they cannot retroactively impose a correct price in a market where value is determined in real time by a combination of domestic and global forces. This reality underscores that understanding the exchange rate movements requires thinking about system dynamics, not just individual misconduct. And the solution is long term reform and transparency rather than short term rebalancing. Let's unpack what the recent moves in South Africa's foreign reserves and the FATF delisting actually mean, because on the surface, it sounds like a win, but the implications are more nuanced than most people realize. On October 7, net foreign reserves rose to about just under 68 billion USD from roughly just under 66 billion in August. That increase matters because it strengthens the South African Reserve Bank's capacity to intervene if the rand comes under pressure. It's like having a bigger safety net. The central bank can use those reserves to stabilize the currency temporarily, so buying or selling dollars to prevent extreme swings. Reserves also act as a signal to investors that the country has some buffer against external shocks, whether it's from commodity price swings or global interest rate changes. On October 24, the FATF announced that South Africa would no longer be on the enhanced monitoring list, which removes a layer of international scrutiny. That might not sound exciting, but it reduces transaction friction. It lowers compliance costs and signals to global investors that South Africa is moving in the right direction when it comes to financial governance. So, taken together, both developments can spark short term confidence and modest rand strength, which is why you saw small rallies in the 17 to 17.25 cents range. However, while these headlines are positive, they don't fundamentally change the factors that drive the currency over the medium term. Reserves gives the central bank more flexibility, and FATF removal makes the country slightly more attractive to capital, but neither will suddenly rewrite South Africa's political, economic, or governance realities. If the country does not continue on a path of structural reform, the currency's underlying vulnerabilities will remain. Now, it's important to think about why these moves matter in context and why they cannot be overvalued. Foreign reserves act like a buffer, but they are only effective if markets trust that the country has the policies and institutions to support them. Investors are not just looking at numbers in a bank account. They are looking at governance. They are looking at debt levels, at political stability, energy reliability, and growth prospects. If reserves are rising but growth remains weak or corruption continues to be an issue, then the market treats those reserves as temporary protection, not as a reason to reprice the currency upward dramatically. The FATFD listing also signals credibility, but again, it's a conditional signal. It reduces perceived risk for global transactions, but it does not fundamentally fix long term structural issues. This is why short term movements in the Rand can occur around positive news, like the 67 billion reserves or FATF removal. But lasting strength requires persistent, meaningful reform. Policies that encourage investment, stabilize energy supply, and reduce fiscal uncertainty are what create durable currency value. Without them, the rand sensitivity to external shocks like the US dollar strength, commodity cycles, and global investor sentiment still remains high. So while the headlines are worth noting and give hope for measured improvements, they should be understood as tools that buy confidence and time, not as levers that automatically restore a correct valuation for the rand. The lesson here is that these developments illustrate how markets respond to signals of credibility, but lasting revaluation of the rand is fundamentally tied to consistent structural change over years, not just headline moves or temporary reserve accumulation. Let's think through tax revenue and public finances since the rand moved roughly from 7 rand to 18 rand per dollar, because it's a question that seems simple on the surface, but it's actually quite layered once you account for economic mechanics and purchasing power. The first step is to understand how to measure it in a meaningful way. You can't just add up rand denominated receipts and call it a day, because a weaker rand inflates nominal numbers without telling you about real value. To get an accurate picture, you need to consolidate national treasury and South African revenue service data for corporate income tax, personal income tax, VAT, excess duties, and other streams year by year. Then adjust those figures into US dollar terms using the average exchange rate for each year. This allows you to see how much the state is collecting in globally comparable terms, essentially measuring how the rand's depreciation has affected the international value of tax receipts. After that, adjusting for inflation and GDP growth is crucial because a nominal increase in receipts might mask declining real purchasing power, stagnating revenue relative to the economy. When you do this properly, you start to see patterns emerge. The weaker rand tends to lift rand denominated tax inflows from exports or foreign investment because when foreign currency flows into the country, converting to rand produces more local currency. But if domestic growth is slow, unemployment remains high, for example, or inflation erodes consumption, the gains in nominal receipts may not translate into meaningful improvements in public services or household well being. That is why headline numbers can be misleading. The government may report rising collections, but the real story is about how much of their revenue actually sustains infrastructure, healthcare, education, and redistribution. Think about the implications of these dynamics. It becomes clear that a weaker rand has both opportunities and risks for fiscal policy. On the one hand, higher nominal tax receipts can provide space for social spending, for public investment, or debt servicing without immediate increases in tax rates. For example, revenue from VAT or corporate tax on export earnings can rise simply because the rand is weaker, giving the Treasury additional flexibility. On the other hand, if inflation rises faster than wage growth or tax collections from domestic consumption, then purchasing power of both households and the state is undermined. This creates a situation where the government might have more rand on paper, but citizens feel poorer and the state struggles to maintain service levels. In other words, a weaker currency can disguise structural weaknesses in the economy while temporarily boosting revenue figures. That's why analysts often stress the importance of considering both nominal and real terms alongside the macroeconomic context when evaluating how effective the current exchange rate has been for public finances. Over the long term, fiscal sustainability and the capacity to redistribute wealth or invest in growth are not determined by the headline exchange rate alone. They are dependent on a combination of policy discipline, economic growth, and inflation management. Tracking revenue since the rand fell from 7 rand to 18 rand in this manner provides a framework for understanding how the currency interacts with government finances and what that means for South Africans in terms of public services, social equity, and overall economic resilience. Let's think about land reform not just as a political issue, but as a lever that can change the economic fundamentals for everyday South Africans. The way land is distributed directly affects productivity, income, and opportunities. If land is simply handed over without support, the result is often lower output, fragmented farming, and the risk that investors will pull back because they perceive instability. But when redistribution comes with the security of tenure, of financing options, and access to tools and extension services and clear property rights, it can actually increase productivity and generate real income for families and communities. People are more likely to invest time and energy into land they know they own and that they can farm effectively. That kind of productivity is not just focused on crops, it translates into broader economic activity. When rural communities thrive, they spend more locally, they pay more taxes, they create jobs beyond farm gate. Land reform done well can break cycles of poverty while simultaneously expanding the formal economy. Every household that can farm efficiently or lease land productively contributes to the national tax base and to social stability. Without these safeguards, reform becomes symbolic but fragile, and the risks of mismanagement or market flight can overwhelm any intended gains. So it's critical that land reform is treated as a structured, gradual, and supported process with clear rules and milestones, not as a rushed political statement. At the same time, land reform sends signals to investors that matter for the rand and the economy more broadly. When property rights are clear and contracts are respected, patient capital, both domestic and international, is more willing to commit, knowing that legal protections exist and long term returns are plausible. That doesn't mean large scale industrial investment will magically appear overnight, but it does mean a more predictable, credible environment that encourages both farming and rural enterprises, which in turn creates domestic demand for goods and services. Communities and families who receive land gain not just as an asset, but as an opportunity to engage in sustained economic activity, potentially building trusts, cooperatives, or family farms that last generations. The key here is credibility. With investors, banks, and even local service providers respond to this certainty of a structured rule-based program, which reduces the so-called policy uncertainty premium that weighs in on the rank. When people at the individual, family, and community levels are empowered to use land productively and safely, it strengthens the entire economic system. Rural inclusion, when properly managed, feeds back into national stability. It feeds back into national consumption and fiscal health. Land reform in this way becomes a lever for both equity and growth, a practical tool for households to improve their own livelihoods while supporting broader economic and financial confidence. It's not just a policy or a random idea, it's an actionable framework that can drive long term measurable change across society. Ooh, in all of this, we should probably look at how AI fits into the picture since it seems to be where the future is headed, especially in, financial systems. Artificial intelligence is not just a buzzword anymore, I guess. It's already shaping trading, lending, risk assessment, and surveillance in ways that can either stabilize or destabilize currencies like the rand. If South Africa invests in AI driven infrastructure that monitors financial flows in real time, it could compress transaction costs, it could reduce errors, and maybe even improve the accuracy of risk models across banks, corporates, and even government systems. That kind of oversight could make liquidity more predictable and create an environment where both domestic and foreign investors feel more confident committing capital. Algorithmic trading, when combined with robust data governance and clear regulatory frameworks, has the potential to smooth short term shocks and reduce manipulative behavior because trades can be monitored and flagged and addressed instantly. It can also extend to inclusive financial products such as lending, insurance, and credit scoring for smaller businesses or rural entrepreneurs, which traditionally suffer from poor access and high transaction costs. If South Africa leverages AI effectively, the rand could benefit from stronger, more informed market participation, reducing tail risk from human error, and a more resilient financial ecosystem that supports sustainable investment and measured growth over the next 5 to 10 years. But the other side is also unavoidable. AI can also amplify instability if the infrastructure, governance, or oversight is not up to scratch. Rapid algorithmic capital flows don't wait for politics or budgets or central bank statements. Flash sell offs, instantaneous arbitrage, and cross border contagion could push the rand toward 20, 25, or even 30 rand during periods of global stress, commodity shocks, or investor panic. That's not a distant hypothetical either. These are the tail risks embedded in ultra fast financial workout networks where milliseconds matter and human intervention is often too slow. So South Africa's challenge is that AI does not automatically solve structural weaknesses such as weak growth, high debt, policy uncertainty, and incomplete regulatory frameworks. And these can all amplify the impact of algorithmic volatility. To use AI as an advantage rather than a threat, there has to be a coordinated national strategy. So, to deploy AI for surveillance, fraud detection, and systemic stress testing, while simultaneously improving data integrity, cybersecurity, and real time reporting. So, by doing so, algorithmic capital becomes a stabilizing force rather than a destabilizing one, giving regulators the tools to react before a minor shock becomes a systemic crisis. The payoff could be worthwhile with faster, smarter, more inclusive financial systems that strengthen the rand over the long term and make the economy more resilient to both domestic and global turbulence, while failure to act could magnify volatility to levels the country has not even experienced yet. So it's a coin toss. So what would it actually take to make any rand target, whether it's 17 rand or 15 rand or 18 rand, work for ordinary South Africans? The first thing to understand is that no exchange rate number matters unless it's embedded in a system that actually delivers real benefits to the people.
The people.
You can push the rand up with interventions or headlines, but if power outages stop factories, if debt keeps rising, or if trust in government and banks is low, all that appreciation is just cosmetic. At the top of the list is energy. Predictable electricity and fuel supplies are not glamorous work, but they unlock production in every sector from manufacturing to agriculture. Without that, investors and entrepreneurs cannot scale, the exports suffer, and currency gains evaporate. Next, you need a credible fiscal path. It's about more than slashing debt. It's more about balancing growth and social priorities while making sure that deficits don't spiral out of control. That creates confidence abroad and here at home. And then anti-corruption measures and judicial follow-through come next. People need to believe that contracts will be enforced, that rules apply fairly, and misappropriated resources are recovered. That's the backbone of credibility for both local and foreign investors. On top of that, foreign reserves and market communication must be leveraged intelligently. Reserves can smooth shocks. They can reassure markets during periods of volatility and prevent panic-driven outflows, but they are not a permanent fix. Policy credibility must carry the weight in the long run. Industry policy matters too. Building refineries, local processing, and export-oriented value chains means that South Africa can capture more of the revenue that currently leaves in raw commodity exports. I'm looking at Burkina Faso, so many lessons there. That revenue eventually flows back into wages, into social spending, and infrastructure, creating a positive cycle for the rand. Beyond macro and industrial levels, there are social dimensions that cannot be ignored. Land reform with productivity support can empower communities, they can increase domestic production, and they can widen the tax base if it's done transparently with proper financing, training, and legal certainty. Education and wage growth must be linked to productivity gains. Otherwise, a stronger currency only benefits investors and not workers. So South African Reserve Bank independence and transparency are crucial. Markets respond to clear, consistent signals, not political noise or conflicting statements. Active capital flow management tools like temporary controls or taxes on short-term inflows can be used selectively to prevent speculative surges from undermining stability. And finally, citizens must be able to see the effects of policy in concrete ways with clear KPIs, public reporting, and visible outcomes. They help people connect reforms to their daily lives, right? The overarching point is that achieving a durable improvement in the rand is long, difficult, and sometimes politically costly. Quick fixes or aggressive headline chasing might deliver short-term currency headlines, but they do little for long-term living standards. So if South Africa focuses on energy, fiscal credibility, corruption control, industrial capacity, land productivity, education, wage growth, monetary transparency, and measured capital management, the rand target, whether it's 7 rand or 15 rand or somewhere in between, can actually translate into better jobs, into higher incomes, and more affordable goods. The question for policymakers is not whether a specific exchange rate is achievable tomorrow, but whether the systems are in place to make that rate work for people over the next 5 to 10 years and hopefully even beyond.